This week's economic landscape has been marked by a series of notable events and significant developments across various sectors. Here is what you need to know. The Federal Reserve held its meeting on June 20th, maintaining its policy rate, but delivering a hawkish tone. Median staff projection now forecasts only one rate cut in 2024, a reduction from the 3 previously expected in March. This change signals the need for more evidence of disinflation despite a recent slowdown in core CPI inflation. Fed Chair Jerome Powell, however, mentioned that up to 2 rate cuts are still possible this year, emphasizing that these projections are not set in stone but are rather possibilities. In the European markets, the European Central Bank, ECB, made headlines with its first rate cut in a year, as announced on June 21st. This move was largely anticipated due to the ongoing economic pressures within the Eurozone. The ECB cut its deposit facility rate by 25 basis points, setting the tone for a gradual easing cycle. The bank also indicated a quarterly pace of easing moving forward, aligning with its objective of stabilizing the economic outlook amid persistent inflation concerns. The Bank of England, BoE, also made a significant announcement this week. On June 22nd, the BoE maintained its bank rate at 5.25%, but hinted at a potential rate cut in August. The decision was described as finely balanced between maintaining the current rate and implementing a cut. BoE's statement highlighted the dampening effects of a tight policy stance and attributed the continued strength in services inflation to volatile categories. This dovish tone suggests an increasing inclination towards policy easing, contingent on economic data in the coming weeks. Meanwhile, in emerging markets, central banks have been adjusting their strategies in response to shifting economic conditions. For instance, market expectations for monetary easing in emerging markets have significantly retreated in recent months. This shift is due to a delayed Fed easing cycle, which has exerted downward pressure on emerging market currencies, posing upside risks to imported inflation and inflation expectations. Consequently, investment strategies have been adjusted, reducing overall exposure to emerging market local bonds and focusing on select markets where continued monetary easing is anticipated. The broader economic indicators have also shown mixed signals. The June Flash Purchasing Managers Index (PMI) for the euro area fell to 50.8, driven by a broad-based deceleration across both sectors and regions. In the UK, the PMI decline was mainly due to weakening in services, partially offset by manufacturing activity. This slowdown in growth momentum in the second quarter supports the case for further easing by the ECB and the BoE. Additionally, UK inflation has returned to target levels, with annual headline inflation falling to 2% for the first time in 3 years. However, services prices remain sticky, exceeding BoE projections due to strength in airfares and accommodations. Looking ahead, elevated services prices may persist in June due to summer events, but are unlikely to preclude BoE rate cuts given their temporary nature. Overall, this week has been pivotal in shaping monetary policies across major economies. The Fed's cautious approach, the ECB's rate cut, and the BoE's dovish signals all underscore the delicate balance central banks are maintaining amid a complex economic environment. These developments highlight the importance of active and agile investment strategies to navigate the evolving market conditions. Investors and policymakers alike will be closely watching the upcoming economic data and geopolitical events to gauge the next steps in this dynamic landscape.